This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Hey, this is Greg Arthur, and I am welcoming you to the show very slowly and calmly. I keep getting a little too excited at the show, and I keep blowing out my mic according to my future. So I thought I would be nice and calm, although don't misunderstand, I'm crazy excited about this topic because I truly could not figure out the answer. I have a question for Andy that we're going to ask him. I went online to find the answer, and the answers were abysmal, and I think Robert would have killed somebody had he read those answers. And so I thought we should ask Andy the truth. So today, actually it was yesterday, Andy, I was actually taking your course, and you have a mentor, what's a millionaire mentor, and you just casually threw out this sentence. You said, well, the way you short the dollar, the way you short the dollar is by getting in debt. And I was just like you said it like, duh, common knowledge, 2 + 2 is 4. But to me, like subconsciously I knew that equation, but I never had that plainly put to me. And so it got me thinking, because in this time right now, we're going through COVID, we have trillions of dollars hitting the economy, and that should mean the dollar is going to get super weak. So now is the perfect time to shorten it. So I started going and doing research, and everything I read was, well, you got to get certain dogs to bark while you're talking, and then you also need to get certain ETFs, and it didn't feel right. So Andy, I wanted to hear your perspective. Wow, I'm going to stop talking and let you do all the talking. Thank you. Your perspective on how to use the stock market to short the dollar.
This is awesome, Greg. This is so timely. I've been tweeting about this. It's been a big conversation. Obviously, as you said, with the Fed, not only are they printing money, they're clarifying or revising their statements to say, our goal is 2% inflation, which means we want the dollar to lose 2% of its value every year. And it's not surprising investors would want to say, well, how do I capitalize on that? So this is a fabulous discussion. And the reason it excites me, Greg, is this. You know how I feel about predictions, right?
You love them. That's all you want to do all day, every day.
Yeah. And, probably my least favorite question is, hey, Andy, what do you think Apple's going to do? Or what do you think Tesla's going to do? Or, I'm always asking to be predicting stocks up or down, or, gold up or down. And so I don't predict very often, but I'll tell you, when you step into this arena, if someone was going to force a prediction out of me and they were going to waterboard me and they got my arm behind my back saying, hey, I won't let go until you get a prediction. This is my prediction, and it's the most confident one I have. It's the one that I'm basing much of my own investing around. I know Kenny, all of his investing is based on this, is the idea that the dollar is going to go down in value. And I bet on inflation big time.
Yeah, absolutely.
There's several reasons I bet on it. Number one, I was born in 1968, so I'm a little over half century old now. And in 1971, they took the dollar off the gold standard. And, I remember 35 cent gasoline and 25-cent candy, and Coke now is $1.50, whatever, when you go buy one. So
yeah, absolutely.
So I've seen inflation with my own 2 eyes, and I know the power of it. And I'll tell you. So the idea of making money on something that loses value is a great conversation. So let's start with this. If you want to short the dollar, don't be long.
That seems a little common sense there.
Let's start there. So what does it look like to be long the dollar? Well, if you understand, if you've ever played the game cash flow, which I highly, highly recommend you play, you begin to learn what a financial statement is, and you have a balance sheet.
Right. I would say that's the greatest value of that game, is it really shows you how money works and interrelates.
We play it on Sundays. We didn't play it this Sunday because my kids' buddies were sick, so they didn't come over, but generally on Sundays, that's what we do, is we play cash flow, and we have an asset column and a liability column in the balance sheet. So long positions are things that you own, or things that you say, this is mine. And so if I say I have something or I own something, that's a long position. That's just long as a fancy term for the things that you own. So if I say I have $100 in the bank, you're long $100. You own it.
Okay.
So that's the asset side. Now the liability side is the borrowing side. And if I say I owe someone $100, I'm actually shorting the dollar right there. Believe it or not, I am. And this is really a mind blower. Think about this. Let's do some math with people. If I have something in my asset column and it goes up in value, what happens to my net worth?
Goes up.
If I have something in my liability column and it goes down in value, what happens to my net worth? This takes a minute to think about.
It goes up.
It goes up. So we usually talk about cash flow in this show, but this is a net worth issue. So think about this. I have two opportunities to increase my net worth. A, I can own things that increase in value, or I can borrow things that decrease in value. And that's a mind blower right there. Someone might have to just take a breath, think, whoa, 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 whoa. There's two opportunities to get rich. I either buy things that go up in value or I borrow things that go down in value.
Okay,
that's a mind twister. That's a tough one for people to handle because they're not used to it.
I think it's the difference between Robert Kiyosaki and Warren Buffett. Warren Buffett, right? He wants to own things that are going to go up in value. And Robert Kiyosaki is always saying, get into good debt.
Actually, they're exactly the same. The biggest difference is Buffett does it with stocks and Kiyosaki does it with real estate, but the philosophy is exactly the same. For example, the reason it works is you're paying it back with cheaper dollars. So instead of buying low and selling high, you're actually selling high and buying low. I know that's a hard thing for people to grasp, but all real estate is shorting the dollar. So think about it this way. There's four parts to a financial statement: assets, liabilities, income, expense. And they're going to go in that order. If you were to buy a piece of real estate, what's step one? Borrow money.
Right.
So now you're short the dollar in your liability column. Number two, trade it. We never borrow money and just hold on to the money. We're always going to take that money and trade it for something else, right? So in Robert's case, he trades it for a house.
Okay.
That's step two. Borrow, trade it for someone. Now he trades it for a house. Now, since you borrowed money, you got to pay the money back, right?
Right.
You've got to figure out a way to get that back into dollars. That's called rent.
Okay, so not all in one shot. You can do it in little
4 steps.
increments.
It's always 4 steps. And then the final thing is the expense column, which is the payment back. So borrow, trade for an asset, income, rent, expense, pay back. It's the 4 steps of shorting anything. Well, you could do this with gold. You're really, or you could do this. You could short the dollar by borrowing a dollar and trading it for gold. You could borrow the dollar in a margin account and trade it for stock. You could borrow the dollar in a business and trade it for products, which is exactly what happens in the stock market. So this is a big picture discussion, Greg, that it's not designed, excuse me, we'd be foolish to say, oh, in 30 minutes, you're going to know how to short a dollar. But the purpose of this, discussion would be, oh, there's something more I should learn. Now, let's talk about, we talked about that idea basically of I borrow money and I trade it for something else. The dollar goes down in value and I pay it back in cheaper dollars. And that's where the money's made, is when you trade back and trade for cheaper dollars, like real estate. Maybe I have a house for 15 years. Certainly the rent's going up because the value of that dollar is down. I need more dollars to justify the rent, right? But the payment's fixed. So the dollars I give back to the bank after 15, 16, 20 years, those dollars are much less valuable than they were 20 years earlier when I borrowed them.
And you actually said something important there. This works if your loan is fixed. If your loan's not fixed, they're going to raise the interest rates and you're going to take the loss.
Could be in trouble.
Yeah.
The big reason the banks don't lose on this, though, is amortization. If they didn't have amortization, they'd get killed, because over 30 years, they're always getting back a dollar that's not as good as the one they loaned out.
Right.
So they amortize, which means all the money you pay in the first 7 years is going to the interest anyway. You're not touching your principal. So that's why after 7 years, they call you and say, hey, you want to refinance and start the clock over?
Right. There
Because they make their money on amortization. The last 7 years, that loan is not a good thing for the bank because the dollars they're getting back are not worth near enough. So that way, over a life of loan, you got to pay double for that house, basically.
Yeah. Okay, so let's cut to the chase. That's real estate. How do you do this in stocks?
So you buy stocks. How do you do it in real estate? You borrow money and buy real estate. And let me cut to the chase though, so we don't run out of time. The ETF thing, there's a couple ways you could do this. Number one, you could short an ETF like the UUP, which basically tracks the dollar. Unlimited risk if you do that. Think about that. If I'm long and something goes to zero, that's a finite amount of money I lose. But if I'm short and something goes to an infinity, that's an infinite amount of money I can lose. So shorting the dollar or shorting stocks is riskier. So if someone says, oh, I want to short the dollar, I'll go short the UP ETF. That is incorrect. I'll tell you why. Those ETFs don't take in consideration things like gold, real estate, businesses, stock markets. It's a basket of 6 stocks where you're looking for the least ugly currency in the beauty contest. So in those ETFs, you'll have a basket of, like, you'll have the euro, you'll have the British pound, the Canadian dollar, the Swedish krona, you'll have the, I bet I can name all of them if I think about it. You have the Swiss franc and the Japanese yen and the dollar. There you go, I got them all. And so really, all of those are going down. They're all being printed. They're all being printed by central banks. And so, you know, they're all going down. And when you try to short that, you're just betting that these others will go, or that the dollar will go down faster than they will, which is not that great of a bet. Talking about the yen, you know, probably the only one there that is going to be maybe having a hard time being strong is the Swiss franc. That one probably is going to deteriorate less than the dollar. But the yen, the euro, are you kidding me? I mean, you know, Canadian dollar, British pound, they're all printed. And so a person that tries to short that ETF is really not truly pitting themselves against commodities and stock markets and things that are cool to short, to pit it against. You're just in this basket of currencies that, you know, kind of the least ugly currency in the beauty contest, because they're all ugly currencies, right? They're all fiat. They all should be shorted, if that makes sense. So I disagree with that. Now, the other thing a person could do is you can't go short stocks in an IRA, or, you know, because of the unlimited risk. So there's an inverted ETF called the UDN, which the way they buy and sell their future contracts, flip it. And if the dollar loses value, the UDN goes up. So you go long that, and that means that if the dollar rises, you have that limited risk instead of unlimited risk. But it's still the same basket of 6 currencies. So if a person wants to short the dollar in the true sense, not just being bearish, but really have a short position, they're going to have to borrow money. The first step to a short is to borrow something. And it would be no different than real estate. Borrow money and trade it for something. Borrow the thing that's going down and trade it for something you think is going up. That's a short position.
So
yeah,
can I interrupt you? We talked about some ETFs there, but what about if you then did, because the dollar's losing value really compared to gold, let's say. So what if you did an ETF of gold, a gold or silver ETF?
Well, now that's a great question. Let's say I go buy gold. Let's be part of what Robert says is jargon is part of your financial education, understanding jargon. And a lot of people use short position and bearish position synonymously, and it's not correct, technically correct. You know, it happens a lot because often they are the same, but they're technically different. Let's say I'm bearish on the dollar. So I take my dollar out of the long position and I put gold in the long position. Well, all I've done is taken my dollars to gold. I might be bearish on the dollar, but because I haven't borrowed, I'm technically not shorting the dollar. Does that make sense?
Yeah, absolutely.
I'm long gold. Now, if I borrow dollars, which is a much more aggressive position and much more confident in the dollar, if I borrowed dollars and bought gold, then I'm short the dollar because I'm going to have to, hopefully I trade it for gold, dollar goes down in value, which means gold goes up. Then when I repay it back, I keep the difference, right?
Okay, I'm going to ask you a question that if Robert were here, he'd probably shoot me.
He'd shoot both of us because we're getting too complicated.
Okay, fair enough. What if you took a margin account? So now you're borrowing stocks or money. Can you buy with a margin account a gold ETF? So
Yes.
now you're doing the borrowing the dollars
Yes, you
and you're
could.
going to long on the gold. So are you doing a exponentially more beneficial?
It's levered. The word we're using is it'd be levered, but that's far more risky, isn't it? Not for a beginner. Far more risky.
I'm asking you. I don't know nothing.
Yeah, if people say, oh, Andy Tanner said to use your margin account to buy a gold ETF to short the dollar, well, technically that would be correct in that would be a way to do it, but it's not what I would recommend. It's not an advice, because for a beginner, anything that has to do with debt, like it'd be like Kenny. Would you recommend a new person go into millions of dollars in debt to buy an apartment complex without any knowledge of real estate or how it worked, right?
No, it's incredibly dangerous.
But here's an interesting thing. I've shorted the dollar in business. Let's say I borrow some money and I trade that money for a book that I've written, and I have it printed with borrowed money. And then I sell that book for a higher price, and then I pay back that in cheaper dollars. I've essentially shorted the dollar using debt. So the idea is that I borrow a dollar, I trade it for real estate, and then I pay it back when it's cheaper. I borrow a dollar, I do business, and I pay it back when it's cheaper. If I look at Kenny McElroy's financial statement, I'm going to see a lot of debt on there, and it's not going to scare me. Well, I'll give you an example. In my 4 pillars of investing, I use Kraft Heinz a lot. It's got a low PE. Ketchup's going to be around for a while. It doesn't move a lot. It's not that scary for me to talk about with people. One of the knocks on those guys, Goldman hates them because they have so much debt, right? Kraft Heinz has a lot of debt. Well, to me, I look at that just like Kenny. It's like they're going to pay that debt back in cheaper dollars. And the secret for real estate investors, as long as it cash flows, and you're able to service that debt over time, 30 years from now, those dollars you borrowed a long time ago are going to be paid back. Well, the same's true with a corporate bond. If I issue a bond, I borrow dollars. I trade it for stuff I can sell, and I pay that back in cheaper dollars over time. So what I would say is I would look at, the reason the stock is cool is if you're not comfortable with borrowing money, and you're not comfortable with all that, which you probably shouldn't be if you're a beginner, you have professionals, you have people in that company that you own. So to say Buffett isn't short the dollar, of course he is. He's short any balance sheet of any of his companies that have a dollar in the liability column, he's short the dollar. And so instead of trying to be fancy and short the dollar, just go buy stocks. Buy stocks that have companies that are doing what Kenny does, or doing what a good business would do, which is use debt properly. Apple's brilliant. Apple has billions of dollars in Ireland that if they repatriate, they got to pay 35% or whatever the tax rate is, right? So what do they do instead? They issue bonds at low interest rates. They'll pay back those people that loan them the money in cheaper dollars, and they don't have to pay taxes on it. And so it's a brilliant move by Apple to short the dollar by borrowing it. So it's a big discussion, Greg, and people, can learn what shorting is first. Not just being bearish, but really what are the 4 steps? Borrow, exchange it for something, let the dollar drop, exchange it back, and return what you borrowed. That is shorting. Doesn't really matter what you borrowed the money for, whether it's business stuff, whether it's stocks, whether it's gold, whether it's real estate. If you're in debt, the moment you go into debt and you have that money and you spend it on something else, you're a short position on the dollar. It's that simple. Crazy to think that debt would be a cool thing for those that know how to manage it and the way to get rich. David Ramsey, I don't know what he'd say about this.
Yeah, you do. He would tell you no.
I don't know. He's not here, but he said, are you out of your mind? That's horrible. But actually, go back to what we started with. If I have something in my asset column that goes down, I got poor. But if I have something in my liability column and it goes down, I got richer. And so there's 2 opportunities for wealth: buying things that go up in value in a capital gain, or selling things that go down in value. Where cash flow is so nice is that if you buy an asset that cash flows, now your debt is serviced over time, and you can be short the dollar for 30 years now and just let that money roll in. So,
right. That's the beauty of dividend stocks.
And same thing with dividends. And the beauty of stocks is if I want to buy a company that is short the dollar, now I am actually short the dollar because I'm an owner of it. For example, let's say Kraft Heinz has a little too much debt. But if I look at them and I say, I think they can service this. I think the price of ketchup goes where with inflation?
Goes up.
Goes up, so that debt's not going to go up. That's a fixed debt. Those are corporate bonds. They're going to be fixed. So if I believe the price of ketchup's going to go up, that's going to be easier for those guys to repay those bonds. They're in a short position. Well, if I don't know how to do all that, I go spend $30 and I buy a share of Kraft Heinz with a vision of, just like Kenny, for 30 years, he's going to hold, for however long he's going to hold that real estate. He's not going to flip the house in 3 weeks. He's going to hold that for a period of time and allow that dollar to drop. I can do the same with a stock.
All right, so I got two questions for you. One's more of a comment. This is a conversation I had with Robert Kiyosaki, and he said that Dave Ramsey's advice, don't get into debt. It's really great advice for everyone who's not financially educated or who doesn't have a high emotional IQ, because debt is such a scary tool. It can make you wealthy, but it can destroy you as well.
Debt, the biggest problem with debt is not being able to pay it off. Yeah. Right? That's it. If you have no cash flow, you can't pay it off. That's why it really comes back to cash flow. So if you can't cash flow and you don't have a way to pay it off, and usually the people that Ramsey's talking to, I'm going to give you a definition of good debt and bad debt. Good debt has two things. Number one, I don't pay it off, and the value of whatever I borrowed goes down.
Okay, can we change the first part to somebody pays it off? It might not be you, but it's getting paid off.
Let's use a rental house again. I have a little rental house that I have a nice couple that lives in it. They're the ones that pay that off. True?
Yeah.
They get the rent and they give it to me, so their job and their income pays off that mortgage. So that fits the first criteria.
Yep.
Second thing is what I borrowed goes down in value over time, which is the dollar. So if I have those two things met, that someone else is going to pay it off other than me, and whatever I borrowed goes down in value, that's good debt. Now, what's bad debt? If I'm paying it off and it goes up in value.
Right.
And that's where Ramsey is. Susie and Dave, they talk to people who have jobs who are paying off their own debt.
Yeah.
So that context right there puts them in a good place. Their advantage, and I think the reason I like Dave and Susie, is they're disciplinarians. Look, quit being stupid with your money, quit being out of control. They're about bringing discipline to a person's spending habits.
Yeah, which is the beginning of emotionally mature.
Right. They're really about reducing the expense column and trying to allocate the income to other things other than doodads.
Yep.
Robert, however, and I hope I can put myself, we're more creative rather than disciplinary. Or we're going to say, look, let's figure out ways to explode income. Let's work on the I, not the E. We're less disciplinarian, but maybe more creative.
Yeah. That's why his question is, how can I? Where he hates to say
how can I afford it
that I can't.
Exactly. Instead of, hey, you can't afford this, don't spend it. It's like, how can I afford it? It's a creative process. And part of that is knowing how to short.
Right.
And in a world where we're printing trillions and trillions of dollars, and the Fed has actually come out and said, our goal is 2%. The risk is that the dollar doesn't fall in value. And I just said, that's the one prediction I'd make very strongly. Doesn't mean I'm guaranteed that it's right. Right now, Greg, our velocity of money is at an all-time low. Our money supply is at an all-time high. Right. I can't find, maybe I go back at least to the 60s. The rate at which money is moving is lower than it's been in my whole lifetime, in 50 years, since the 60s. The amount of money we have is more than ever before. So one is inflationary, but one is deflationary. And the Fed right now is in a fist fight, fighting a deflationary economy. Our economy sucks. Come on, yeah. What do you need to print that much money for if the economy is running well? It's on life support.
Right.
So our bet is that as you have this deflationary pressure and the inflationary pressure, our bet is that they will do so much on the inflationary side that's why we're using debt. And if the dollar strengthens, imagine this. Imagine having 1,000 rental properties, and all of a sudden the dollar strengthens, which means rents get cut in half. and now you've got to pay that payment. That's why the criteria for good debt is someone else pays it off, but it also has to go down in value, because if it goes up in value. One more story quick. In Poland, 5-6 years ago in Poland, a lot of people took their mortgage out in Swiss francs rather than Polish zloty, which is their currency. Well, in 2015, the Swiss franc unhinged.
Oh.
It got unpegged from the euro. I think they were using the euro, the dollar. They got unpegged, and the Swiss franc started to go which way in value?
Went up.
So what does that do to that person's balance sheet? If all of a sudden francs are going up in value, well, even though their payment in francs stays the same, they have to get more zloty to come up. So let's say their payment was 1,000 francs a month. Well, they got to come up with 20% more zloty than they did before to pay those. So again, someone else must pay it off, and it has to go where? Down. Because if you think of an adjustable rate mortgage, if the rate is 3%, that loan's okay, valuable. But if the rate jumps to 6%, banks want that loan. That's very valuable.
Yeah, absolutely.
And if your interest rate goes up, that liability is making you poor now. So this is a very important discussion to have. Play cash flow to begin to understand it. I know it's a lot for people to wrap their head around in 30 minutes, but at least can be a start to say, okay, in this day and age, should I understand my asset column and my liability column and what happens when those things go up and down in value at a minimum? That's shorten the dollar.
Okay. Well, first of all, thank you for explaining this, because this is a difficult concept, but you gave us some really simple terms. Going long
is when I own it.
Yep.
Going short is when I owe it.
Got it.
I've traded it away.
And that's huge help. And you showed us how you can use a margin account to short, although your disclaimer, make sure you're educated first.
Yeah, I use a margin account, but I don't use them aggressively, and that's just not a beginner level deal at all. Borrowing money in any event, whether it's real estate, stocks, whatever, bonds, be careful.
Exactly. And that's why the Dave Ramsey message does have value. He's kind of step one. You listen to Dave and you get your emotional maturity. You get your discipline, is the word you used, and then you can move on to step two, where you learn to use debt. But first, you gotta learn to control yourself.
I love that statement.
Well, Andy, thank you so much. Shorting the dollar with the stocks. Who knew?
Buy a stock, you probably are short the dollar, because the company you bought probably has some debt that they're going to pay off in cheaper dollars. So
beautiful.
Buy a stock, you're probably an owner of a company that's in a short position on the dollar already.
Love it. That's as simple as it gets right there.
Beautiful.
All right. Thanks, Andy. We'll talk next week. All right. Bye.